All right, Chris. Good afternoon or evening.
Good evening, Joseph. How you doing this evening?
Doing good. Been a busy and productive day. Had some real good stuff for myself and also for the people in terms of taxes.
Awesome.
Awesome. Anyone who's here first time, this is Joseph and Chris. We are based out of Virginia. Chris is a CPA. I am working my way to becoming an EA. Not there yet, but soon to be, hopefully. And in terms of if you have any kind of questions, tax questions, we love answering those. We love helping people to legally reduce their tax liabilities. And that is why this entire show is all about. So, with that, we actually have a very interesting thing today, to be honest. We are going to be talking about trusts. And as a matter of fact, it can easily become a very complex situation, but the complexity sometimes allows an opportunity. And if you have not been following us, Chris has an enormous opportunity and experience with working with nonprofits, where if you remember correctly, in one of our previous sessions, we explained that tax laws in US is pretty much to control the behaviors of human beings. And one of the ways it is done is to allow where you should and how you should put money. And one of the ways is to grow business where you have job opportunities for others. Second is investment, which we had been having a lot of conversation in the last few episodes in real estate investing and so on and so forth. And the third one was charity. And the interesting thing is, with trust and charity, it becomes such a powerful combination. It can reduce a lot of taxes. And we will be going on a very high level, of course, because as I mentioned, it can quickly become really complex. This is not for structuring trust. This is not a legal advice. We will always recommend lawyers, professional lawyers. If you don't have one who can set it up, let's have a conversation. We have our very trusted lawyers that we can connect you with and also have those taxes sorted out. All right, with that, let me ask Chris this. Chris, what is a trust in the first place?
Well, it's a vehicle that if you want to set aside or set it up for a particular purpose, you can do that. And they're using the same return. It's a 1041. And the estate of a deceased person and trust are using the same return because it's something that's set up to look after money that is to be used a certain way. So that's why they use the same tax form. And you got two kinds of trust. You have a simple and a complex. And a simple means pretty much everything just coming straight out to the people designated by the trust to receive those. Whereas a complex trust is going to is allowed to only distribute certain amounts, and they may only distribute income when certain criteria are met, or they will stop distribution when a certain event occurs. Say a beneficiary of the trust has a creditor issue, or in these complex trusts also have complete discretion to make any distribution as a trustee see fit. So you have to have a trustee who's overlooking everything, who's going to be making sure that nothing untoward happens. So, and we also have revocable and irrevocable trusts. And with the irrevocable trust, the person trustor, you think about Bruce Wayne, okay? He sets up an irrevocable trust for Robin, either Dick Dick Grayson or Jason Todd, if I'm getting my characters right here. And he may say, all right, I'm going to set this up and I'm going to put trustee in charge, but Alfred in charge of this. And I have to back off. I can't do anything about it. And so maybe Mr. Todd is a little bit more loose and just gets into trouble all the time. Says, no. I'm going to make this one a revocable trust so that I can pull things out if I want to. Now, tax-wise, the difference between the two is that an irrevocable trust is going to have its own EIN number, and it's going to be on that 1041 tax return. whereas the revocable trust is just going to be on Bruce Wayne's tax return because he still has control over it. So therefore, the IRS says if you control it, it's on your tax return. So those are just some of the basics, Tusif, and brought in my favorite comic book character, Batman, here to illustrate something. So now I've achieved a goal in my life is to have Bruce Wayne talk about with taxes.
Awesome. I mean, of course, there's nothing wrong about being as rich as Bruce Wayne.
Yeah,
it's just a matter of course, if we had the same, maybe we probably will see similar Batman from Elon Musk or someone. Hey, maybe it happens. We still need some people who are. I personally love the Batmobile. That's awesome. I would love to have one in my life. I don't know if anyone makes one. If someone knows, I would love to have it in some time of their life.
Folks, stay tuned. Joseph and I will have a future video where we discuss which Batmobile is the best. So please stay tuned for that episode.
Absolutely. I'm a mechanical engineer and I had an automobile class. It was really fun, but unfortunately, I'm not in that industry anymore. But definitely, so folks, as to summarize what Chris just mentioned, trust is a vehicle to transfer. The benefit to this is it's a private entity. It's not a public document.
Yep.
Unlike will. Unlike probate. On probate, someone has to go through the entire probate process, yada, yada, yada. Depending on the state, it can become significantly different. Now, when it becomes a trust, it never goes, the assets never goes to the probate in the first place. As Chris mentioned about different roles, trustee, beneficiary, which other one I'm missing? Trustee and beneficiary?
Trustee and beneficiary are the ones, yeah, and then you have the creator who's the one who sets up the trust.
Okay, the one who sets up the trust. Awesome. So here, what it allows you to this fundamental thing of own nothing, pay, and maybe I add pay nothing. If you own nothing, you pay nothing. Mm-hmm. That's one of the best ways to understand the tax rules is not only that pay nothing, but also, as Chris mentioned, if there is a litigation, it's Bruce Wayne, instead of breaking Joker, he breaks the Gotham townhouse.
Yep.
If it is a trust, the Gotham cannot just come after him and sue him. Because if he had a trust, he doesn't own anything. And if he doesn't own anything, he doesn't have to pay anything. That's the bottom line.
Right. And Stately Wayne Manor could be in a trust. As the last Batman movie with Christian Bale, they were going after his assets. Well, if Stately Wayne Manor had been in a trust, nobody could have gone after that and gotten him when Bane took all of his money. That's why you sit down with Chris and Joseph. Yep. Before making that much money. So coming back to the point is, of course, there's simple versus complex, revocable, irrevocable. And as Chris mentioned, that some of them is going to have a separate EIN, some of them no. So if there is a control, I think I put that EIN on the other side, but it's intentional just because you guys don't mix it up. But coming to the element of how we are going to be using it is 3 different sections. We use a very interesting clause of trust and element as charity. As we mentioned earlier, there's 3 different elements that allows or is pushed by the government to us. And one of them is charity. So the moment you have charity involved combined with your trust or your foundation, that becomes a significant amount of leeways, if we want to put it like that. Now, we are going to be discussing in 3 different ways in terms of how to either minimize, defer, or offset. Because when it comes down to tax planning, there's few fundamental elements. Is first of all, if you can reduce the amount.
it typically has been done by deductions or credits. The second way is if you can move things around. Like if someone were to have an expense instead of January as opposed to December, the December one picks up the previous year's tax returns, and you get a bigger deduction. So that's why timing is a significant, important thing where depending on when you take and realize that amount, that helps us significantly in the tax planning side. And the third thing is, of course, how you offset it. So you already made money, you already realized, now how do you offset that element? In the minimization side, it has to be done, however, even before the taxable event happens, even before you make the money, even if before you make the sale of the property. So say, for example, someone were to come, as a matter of fact, I am having conversation with a big multifamily deal where the clients are going to have a significant amount of capital gains in millions, to be more precise. So what we are proposing is instead of selling it directly to us, why not have a charitable organization? So CRT, as you just mentioned, these are some of the examples. You might have a lot of others as a same thing previously. If you don't have a lawyer, let's have a conversation. We might be able to help you out, or sit down with a lawyer to understand and sit down with all the nitty-gritties. But these are some of the things that can be done. So the CRT CLLC is Charitable LLC, Limited Liability Company. 501c3 is one of the types, which is pretty common, where if you do donate to 501c3 organizations called exempt organizations, you get a tax deduction even if you are a W-2 employee. And on the property sale, if you transfer your personal ones to charitable elements, either CRT, CLLC, or whatever, that gift, all of that gain and the recapture becomes tax-free. So you're essentially not realizing those back again. So say, for example, you have been holding an apartment complex, 50 units, 100 units. You have depreciated enough for the entire 27 and a half years. Now you cannot depreciate it anymore. What do you do then? You open up a trust that has charitable clause into it, and then donate to it or gift it to it. So if that same property is sold inside that trust, it does not realize gains. And tax returns, as Chris was mentioning, the moment it becomes charitable organization, in most cases, it becomes informational returns. Am I correct, Chris?
You're absolutely right. Now, folks, I want to warn you that when doing that, you can't. It's not like you're applying for what is that? An employer identification number. Just quick film here. Some of these applications to get a 501c are about 20 pages long.
Absolutely.
So it pays you to sit down with an attorney or Tusif and I to walk you through this to make sure that everything is set up properly. So don't just think that, oh, it's like getting an EIN, I'll just set this up and boom, we go. No, it requires a little bit more. You need to get approval from the IRS, which you need to think about this months ahead of time. We
Absolutely.
can't do this right now because it's not going to be set up for 2023. And the IRS is having a backlog, and they're still looking for employees. So please just know that if this is something you're thinking about in 2024, let's set up a conversation so that we can have this and get you set up with that attorney that Tusif is talking about.
Absolutely. So there's a great friend of mine. He does all of these trusts, and he's great at all those setups. We can definitely hook you up with him. But for now, as Chris mentioned, is the latest backlog that I have been seeing takes at least 8 to 10 months. So you can get the EIN, but to actually get approval as that charitable thing, you need to wait that long. So that's why I said minimizing it is significantly before the purchase or the event that is happening. And of course, make sure to, whenever you're doing those, make sure to understand there is another interesting element in the tax law that is about to change. We hope it doesn't, but it's most likely we'll see what happens in next year as the TCJS expires, is the gift tax limitation becomes from 12.6, which is most likely going to be 12.9, depending on when you're listening to this, dropping to almost 4.5 to 5, that range, depending on how much we are going to be ending up with. So make sure to, whenever you are doing those transfers above that, you will be realizing gift tax, which is another 40%, unfortunately, depending on what there is. Now, moving to the deferment, of course, we did talk about 1031 exchange, where you're literally rolling over and deferring that entire thing. But talking about the external escrow trust, what it interestingly does is the power of this is it treats the sale as an installment sale. And the way it does is, even though getting the money, even though the trust gets the money at the same time, it treats it, it tells the IRS that, hey, we are setting it up as deferring as an installment sale, so that the amount realized on each gain is significantly shorter, so that when you're already there, you're pretty much, what you're doing is just adjusting how much you need to have depreciation or passive losses from other sources. That is what it does. And that is why the timeline is really important. When setting it up, you need to tell IRS how long this is going to be happening. And the fact that it allows, say, for example, that millions in dollars in capital gains, if someone's coming in and say that, hey, I'm not going to pay millions in dollars in taxes, I'll just flank it out. IRS is just going to send everything at you. They got $80 billion in funding, and they're hiring, as Chris mentioned. So that timeline is really important. So whenever you're doing this as a part of your tax planning, understand what are the consequences and what timelines you guys are working with. Sit down with us, sit down with your attorney, let's have a conversation. The last one, though, is CLT, Charitable Lead Trust, or syndication. So say, for example, you already ended up with that. What's gonna happen? So now what you need to do is actually offset that money. So when you already have realized that, if you donate to charity, there is a new, I mean, of course, it's not brand new, it's been there for a while. But if you're doing cash contribution, of course, depending on when you're looking at it, how that's structured, this is also, all of these are going to come into play. You can deduct up to 60% of your cash contribution, even if you're W-2.
Now, Yusuf, I just wanted to clarify. Now, my understanding is that it was, you can deduct 60% of your income,
yes,
on your tax return. So
yes,
it may not be the contribution. You may be able to give the contribution, but it's going to be the income. But if you don't take it this year, it'll roll forward to a future year. So
yes,
just want to make sure you're clear on that.
Yes. So as Chris mentioned, 60% of the income.
Yep.
And of course, if you took more than 80% of your income to charity, you're not going to be able to take the entire 80%. Let's be honest. So if someone made $5 million in W-2, he lives off of $200,000 in anywhere in US, he wants to donate 80%, that's what, $4 million, he can only get up to $3 million in a given year. Now, again, if it is public charity, it can be 25 to 30%, depending on what it is, depending on when you're hearing this. And if it is a private, it becomes 20% if it is non-cash. So say, for example, you are having these foundation and trusts to leverage your, as I mentioned, capital gains. That amount from your personal assets that is how much you can actually write off. Or, as Chris mentioned, to be taken against your W-2 or your actual income, which in other tax return noted term is called AGI, adjusted gross income in many cases. So even though these terms are used interchangeably, they have legal meanings in different cases. So I don't personally like using those interchangeably, but whenever you are sitting down with your CPA, sit down with them and understand what actual implications are there and how much can you, and when you are doing it, what can you write off. Anything to add here, Chris?
No, Tusif, it's been very educational for me. I've had a very small amount of knowledge of trust. I know how to fill out the form, but this is why what I tell my clients, and we'll tell Tusif and I will say is, look, if you hear something about something, shoot it past us. If we know about it, we can give you an answer, and you'll think, okay, they're great. I'm going to tell the whole world about Tusif and Chris, and you need to have these guys to do your taxes and help with tax and saving plan money on this. But if we don't know, we can look it up and get smarter. We're going to have a lot to get smarter. Tusif, after he passes that EA exam a little bit later, he's going to feel like King Kong. So praying for you, Tusif, do that. But this is something, I saw something today that said a man who stops learning on the day he graduates basically loses everything. But Tusif and I keep reading and learning, and Tusif is helping me with my education because I'm don't always know. So Tusif, everything there sounds great and just along the same lines of what I had heard about. So keep going, I'd say.
Awesome. I mean, I know Chris is being humble here, but a lot of those previous episodes, you probably have seen me learning from Chris. So definitely,
we're getting smarter. Iron sharpens iron.
Absolutely. So with that, I mean, today I know we talked about a lot of very powerful, very powerful vehicles. As we mentioned on our previous episode, is tax preferred vehicle. These are some of those as well. So this is pretty much a continuation of it. But remember also, when you are leveraging each one of them, depending on what type of income there is, you might be able to recognize some of them. So say, for example, if you're into syndication, go back and see some of our previous videos where we discussed about the syndication, which position you are going to be in. And that's how the amount you're going to be realizing as taxes as well. Another thing to be very cognizant of here is these elements are not something that you just put down and take money out. That's not how these work. So charity, of course, you need to understand that these are for the betterment of people. If you're actually involved into something, like a lot of my real estate investor friends are involved with group homes or sober living, and also I forgot the name, the element where people are right out of jail, they keep them into a house, then they're
halfway house.
Halfway house, yes. Halfway houses. So I have friends who have all of those elements. And as a matter of fact, those can be treated as charity as well, since these are actively helping people. So now the way you were doing business inside that, can these trusts own businesses? Yes. Can these trusts own LLCs, other businesses? Yes. Can these trusts own real estate or assets? Yes. Now, when you are taking or touching money, make sure to understand and structure yourself on that, depending on how much control you have, is that trustee and the beneficiary. These are the two fundamental things, how and if you're going to be touching it. But the moment you remember, the moment you're touching directly into any money, you are going to be taxed. But as long as the ownership of it is within that charitable organization, that element does not recognize tax, or that's the fundamental purpose of being exempt. But of course, if you're trying to take money out, it's not a bank kind of thing, but of course, it does defer taxes. And for you to touch the money, then you put on further vehicles cascaded inside them. Like you operate, have another business, you take salary out of it, then you don't pay the self-employment tax, as opposed to if you were to do that on a self-employed sole proprietor, man, we showed you that depending on the state, it can be up to 65%, depending on how much you're making.
Mm-hmm.
So these are the elements that you could essentially do to literally, in some cases, forget about all the capital gains and even significantly reduce your W-2. I think I would not want to have it too long today because it's a huge element. People might want to go back and rewind and rewatch this. I would like to
we don't want to overwhelm everybody here. We just take this a spoonful at a time.
Yep. Anything else you would like to add, Chris?
No, there's a lot of elements, and it just requires just sitting down and thinking and having a conversation. And then kind of, I usually was a show. It was back in the 80s. It was called MacGyver, and he just would find ways to just interesting ways to get out of it. There's a lot of tools that Tusif and I we either know about or can find out and say, well, what's your situation, and seeing what can be done. This is what we can do. It's not, we're not sitting here and just putting little numbers in little boxes. It's all right, what's the way that we can get around this and keep you out of trouble? I did a radio podcast a couple of years ago, and we talked about how we're kind of samurais, and what samurais are, they kind of stand in front of their lord, the emperor, and they were there to protect the emperor. We're here to protect the emperor, and just have a cool sounding name like samurai here to protect you and to serve you. So that's what we do here. And if you have questions, you're out with friends, and someone throws some preposterous sounding idea at you, run it past Tusif and I and see if they're actually know what they're talking about. I always use the example. Someone says, you ought to get an alpaca and use that in your business, because that'll be a big tax write-off. Well, maybe, depending on what kind of business you do, but please run it past us to see if there's something to it.
Absolutely. To be honest, animals can also have capital gains.
Yes.
Remember this. If you are especially like anyone in the horses, yep. I had a conversation with a very good friend of mine. She is, too much into horses. She trains with Olympic riders. I think she's at her 50s or 60s, still trains with her Olympic riders and stuff. So if you just come up and say that, hey, I think an alpaca is going to save money on my horses, I guess you're not going to be able to use alpaca on riding. So
let's see what we can do with it.
Yep. But hey, Chris, I feel like it's been a very informative session. I would love to keep this one really concise today. And we will be talking about more elements in these creative strategies in our next videos. So make sure to subscribe. And if you have any questions, feel free to reach out in comments and Facebook and in any other forms if you personally know us as well. With that, I appreciate Chris and everyone who is watching and who will be watching as well. And with that, I will be closing down today's episode of that. Thank you. Have a good one.